कोणता नंबर?
Even Bhakti is asking for the link share for what?
Unmute down. Mute the bottom.
Pitria.
ನಾ ವೇಟಿಂಗ್ ಅಂತ ಅವರು ಕಾಣಿಸುತ್ತೆ ಈಗ ಅಷ್ಟೇ.
Good morning, everybody. Good morning, sir. Good morning, sir.
Yeah, hello, good morning, sir.
Good morning, sir. Jindabad.
Good morning.
Good morning, sir.
Very good morning to all.
Good morning, everyone.
Good morning, sir.
Good morning, sir.
Good morning, sir.
Good morning.
Good morning, sir.
Good morning, sir.
Good morning to all.
Hello.
Good morning, sir. This is Adivas Mitra.
म्यूटेड, उन्होंने म्यूट कर रखा है आगे से। ओके
सभी को नमस्कार। सतीश जनचेतना संस्थान। इट्स नॉट
वो आगे
लिख भी देना जी भी इस तरह। आपकी नेट से कनेक्ट है।
అలానా
लिख देते हैं।
என்னோட ஸ்கூல் ப்ராஜெக்ட்காக நான் டைஜஸ்டிவ் சிஸ்டம் பண்ணிட்டேன். உங்களுக்கு today அதே பண்ணிட்டேன்.
Good morning, everyone.
I think there is a echo. Could you please
Good
arrange?
morning.
గుడ్ మార్నింగ్ సార్.
गुड मॉर्निंग। गुड मॉर्निंग।
150 ఉందా? వినడం పెద్ద అవుతుంది.
Yeah, good morning. Yeah, I hope now it is not echoing. First of all, welcome to this first webinar. So, whoever have joined, may you please write your name, designation, and organization name in the chat box. We will try to mute everyone. Whoever has any queries, please write in the chat box. After this session, we will answer all your questions in the form of a document and share the link with all of you. We will try to make this session, the session will be in English language. Because combining both English and Hindi may be difficult in one session. If there is a requirement for Hindi, we will be more than happy to have one session exclusively in Hindi. So if anybody feels that at the end of the session that it should be in Hindi also, or during the period, please write. We will have a separate session for Hindi. This session will be specifically covered in English language. I'll try to make it as simple as possible. Yeah. So perhaps you might be wondering about these sessions, why it is so important, or why is it Foundation, Azim Premji Foundation is planning to do these sessions. I'll give a little background as I start the session. Why we are doing these sessions? So in principle, what we taught at Foundation in the changing regulatory environment, and as we are to understand what are the changing regulatory environment and how NGOs or organizations in the development sector have to cater to these requirements if they have to be compliant. So being compliant is inevitable step in creating that we will discuss on what the sector can adopt so that long run a sustainable option for these sessions are quite important and and to understand the requirement and also to take into account that it's not just saying something we have to do, but what is the purpose behind saying something, why we should do. So governance, people at the management level, at the governance level, at the programmatic level also, it will be good that you try to understand the concepts. And these webinars, we will be focusing on a specific topic and trying to in a particular topic, so that we do not overwhelm you with many information in one session. During the monthly sessions, we try to
पूरा इंग्लिश में चलेगा, मुझे डेट दे देना फिर बाद में क्या क्या है.
So during these monthly calls, we try our best to take you through
It's showing me as organizer. Why not have us speak for you? Then I can do mute on. You use the screen for sharing. Oh. So Praveen, you take care of muting, I can do mute all, and Rajni will speak from mine, but you show the screen. It's showing so all from you. Yeah, it is showing you, but who's it showing as organizer? For me as an organizer. Oh, okay. Is it showing you as organizer? Because if you do mute all, you will also get muted if you're not the organizer. I'm not organizer. So then I'm the organizer. I'm going to do mute all, and then I'm going to unmute myself. You can do admit all on top every time. Yes, but I'm going. We should mute everyone in the meeting. Yeah, I'll take it. Hello, are we audible now? Yeah, please mute.
Yes.
Yeah, just give us a minute. We are just trying to ensure that only this mic is unmuted. Yeah. Okay. So all questions will be taken at the end. Rajni will be speaking now. The session is recorded. Your chat messages will be, we will capture the chat messages and we will respond to queries later. So, yeah.
Yeah. So, good morning all. We will be starting the presentation. As informed, this session will be in English language. If at all there is a requirement, we would be more than happy to conduct a session in Hindi also. But this session we will focus speaking in English language as such. So let me start with an example. Now, when we introduce someone, how do we introduce? We introduce say for example, if I'm introducing myself, I introduce myself saying that I am Rajni Gopal Krishna. I am from Azim Premji Foundation. I am working in the program finance department and I have a qualification of so and so. So what does this mean? In a nutshell, in a short span of time, I'm trying to myself known to the people around me. So I am introducing myself about what I am, who I am, and what I am doing. Similarly, for an NGO, when it is working, an NGO is working in various spheres, and we have to make the activities known. So what is it that we make the activities known? One is through a website. We will have our own website. Organizations will also try to demonstrate what programs they are doing through pictures or, they will put as the about us. I mean, there are many things on the website which helps any newcomer, any person who is accessing, who has to get information, to get a snapshot of what the organization is all. Now, this is coming to the programmatic part. What about the finance related? Because NGOs are accountable. The NGO, as the name suggests, it is a non-governmental organization. So this is an organization which is trying to fill the gap in the society by doing those activities or programs which is benefiting the society. So, in principle, NGO is accountable. And how is this accountability and transparency ensure? There are various laws, rules, regulations, statutory requirements which make NGOs to comply with various disclosures. So when we say disclosures, one of the disclosure is also, since an NGO is income tax is exempted, you have to comply with income tax requirement. So one of the requirement is you should have your financial statements prepared. These financial statements have to be audited year on year, and it has to be submitted to whichever statutory agencies. Say, for example, if you are registered as with the Register of Society, Then you have to do annual filing with the Register of Society, in which, apart from your governing body members, you should also submit audited financial statement. And no matter which type of registration you are in, you have to also file your income tax return, which means you are uploading the financial statements, audited financial statements, audit report, and also all the details on the income tax website, which means the government knows about the organization. So this in common terminology is called as financial reporting. So what is financial reporting? Financial reporting is a wheel, is a mechanism through which we can ensure accountability, transparency, disclosure of information as required by the various statutes. So this information is very essential, and what we display, it is as good as saying how I present myself is what I am. That is how people know me. Similarly, what we mention in these financial statements is what the organization is. This is how the organization is known to the general public, government, statutory bodies, donor organizations, beneficiaries, and all other stakeholders. Now, let us go to next slide. So, let us see how this financial reporting goes. When we say financial reporting is like that snapshot, that is the information that goes to the public. So, there are two things in financial reporting. One is audited financial statements. Another is auditor report. So both are audited. Just take these terms. I will explain these terms little bit detailed later. When we come to financial, audited financial statements, there is again a segregated. It's segregated into two. One is the set of statements that helps us to understand what is the financial position of the organization. And another diagram.
Yeah.
And another is which specifies or which helps us to understand what is the financial performance of an organization. So when we say position, financial position, that is balance sheet. I'm sure all of you are aware of the term balance sheet. Balance sheet says balance sheet of XYZ society as on 31st March 2024. Please understand the term used is as on, means as on a particular date, what is the position of an organization in terms of its assets, liabilities, capital, investments, and other things, which comes part of the balance sheet. So it is as on. Now let us see the other part. What it says, performance of an organization. So those are receipts and payments account and income and expenditure account. These two are commonly the statements which are prepared by the organizations. Now, when we say income and expenditure account, how we write? Income and expenditure account of XYZ society for the period ending 31st March 2024, which means it is from 1st April 2023 to 31st March 24. What is the total income? What is the total expenditure? So it clearly, the segregation is balance sheet is as on a particular date, whereas statement of performance, which is income and expenditure and receipts and payment, is for a particular period. Now, how are these things derived from? Where is it derived from? This is derived from your books of accounts. So, generally, organizations maintain day book, cash book, ledgers, vouchers, memorandum, and other documents. So, these are the main documents which the organizations have. So, let me come now backwards. The basic document is books of accounts. From books of accounts, financial statements are prepared. So financial statements are of two types. One is the statement of position, another is the statement of performance. Statement of position is the balance sheet, which is as on a particular date. Statement of performance is the income and expenditure or receipts and payments account. Sometimes it will be both organizations prepare. So which gives whatever is the income or expenditure or receipts or payments for a particular period. So this will be audited by the auditor, and this is the state. So audited financial statements and auditor reports are the basic of financial reporting. So if an organization's work has to be known how it is doing in terms of financial matters, financial reporting is quite important. Next slide.
Just a moment, Rajni. There are some people saying that your voice is not audible. I just want to know if nobody can hear.
No, it is audible, clearly audible.
It's audible. Okay.
Yeah, now it's audible.
hearing.
Thank you. So
It's breaking.
Now it is
Please
audible.
Clearly
audible, ma'am. Loud and clear. We could hear properly now.
thank you. Thank you for confirming. I'll be muting everyone again.
Okay, now let us come to the few terminology which we feel is critical for us to understand whether we are in the governance or we are in the programmatic. Of course, but for people who are in the accounting stream, it will be a refreshing. Now let us understand what is bookkeeping and what is accounting. So bookkeeping is a simple recording of financial transactions. Let me give an example. A laptop is purchased for 45,000. So when we are doing bookkeeping, what we do, we just mention purchase of laptop 45,000. It closes there. That is bookkeeping. Bookkeeping is maintaining the record of transactions. Now, what is accounting? Accounting is a system of classifying the expenses, classifying the transactions, recording the transactions, the period at which it is recorded. So there is a whole system. It is a scientific system of recording transactions. So when we say accounting, it helps us in interpreting those transactions. Say for in the same example, when we say laptop is purchased for 45,000. So what happens when we do the accounting? We account it in a manner. To that extent, cash is reduced, laptop, fixed asset is purchased. So we are able to interpret in the financial statements that in the balance sheet that there is a purchase of fixed asset, equivalent capital fund is created. So we are able to analyze just by saying the purchase of laptop 45,000, we are not able to analyze or interpret the interpretation. However, when we do the accounting in the scientific method, we will be able to interpret, analyze, classify various transactions, which is very much required for financial reporting. Next slide. Let us understand the next terminology. Generally, if you hear many organizations, when the finance people come, either as auditors or as for the due diligence, the common terminology they use is chart of accounts. Now, what is this chart of accounts? It is the list of account names, which is generally used by the organizations to classify transactions. Now, what is broadly, it is under 5 categories. One is assets, another is liabilities. Then we have equity or capital, what we call it. Then we have revenue, which is also called as income. Expenditure is the other term. Now, when we say the same example, I'll take purchase of laptop. What happens? It's classified in 2 heads. One, asset. Another, equity or capital. When we say I have incurred an expenditure. Organization has incurred an expenditure of around 10,000 for a workshop. What happens? there will be expenditure which is incurred. So it will be classified. Workshop expenditure will be one of the ledger which is created under expenditure head. So under these 5 heads, generally chart of accounts are created and classified. So now when you look at balance sheet, what happens? On one side, we have capital and liabilities. On the other side, we have assets. So in a nutshell, assets is equal to capital and liabilities. So when we say assets, which means fixed assets, investments, cash in hand, cash at bank, debtors, all these are assets, means this is available. These are the resources available for the organization. How it is represented? It is also equal to capital and liability. So as the name suggests, balance sheet means it is a statement where the left-hand side and the right-hand side is balanced. So balance is one of the important terminology in accounts, which means for every debit, there is a corresponding credit, which means for every income, there is a corresponding expenditure, or it is also shown as amount available, or in accounting terms, it may be called as capital fund or general fund. So either all income will be shown as income, there will be a corresponding expenditure, or if there is no corresponding expenditure, it will come and sit as a fund. So accounting equation in simple language is assets is equal to capital plus liabilities. Next. Okay, now let us come to system of bookkeeping. So when we say bookkeeping and accounting, it's, please understand, the major difference is bookkeeping is just recording of transactions. Accounting is recording in a scientific way. So there are 2 systems of bookkeeping. One is double entry system of bookkeeping and another is single entry. Just go through this example. Interest received 1,500. So when we say interest is received, what happens? As I said, for every debit, there is a corresponding credit. For every receipt, there is a corresponding payment. So that is an example of double entry. So when we say interest received, what happens? Interest has come. How it has come? It has come in the form of bank note. So what will the entry be? Debit bank account and credit interest received. Another example, Mr. A gave loan of 10,000. So again, what happens? We are receiving the amount. So bank or cash account debit, loan from Mr. A credit. So this means for every transactions, there are 2 entries passed. This is what is called as double entry. In single entry, what happens when we say interest received? We will just write in one Excel sheet, received interest, 1,500. That's all. Now, which account, corresponding account is getting affected will not be reflected in the single entry. Now, let me just take you through the rules. In the above example, when we said loan is received, the loan is given by Mr. A. So what happens? A has given loan. So the thumb rule for personal account is debit the receiver of the benefit, credit the giver of the benefit. In this case, Mr. A has given loan. His account is credited because it is a personal account. Next is real account. Real account rule is debit what comes in, credit what goes out. So when A has given loan, then cash or bank you have received, it is a real account. So that is why in the above example, we have written debit bank account and credit loan from Mr. Now the third one is nominal account. The nominal account rule is debit all expenses and losses, credit all incomes and gains. So in the first example, when you see, it's clear, bank amount interest is received. So debit bank or cash and credit interest received, because interest received is income or gain. So it is a nominal account. So there are in general, there will be three types of accounts. One is personal account, one is real account, and another is nominal account. So in double entry, there will be a debit and a corresponding credit. Now, sometimes there may be one debit, two credits, or two debits, one credit. So we will go in, I will not touch upon those details now, but understand, as we told earlier, it is a balancing principle we use. Means wherever there is something on the left-hand side, equivalent amount will be on the right-hand side. So this is why we call it as balance sheet or trial balance, which helps us to match all the debits and credits. Now, what are the differences between double entry and single entry? So, tracking. So, in single entry, we track only income and expense. Whereas in double entry, we also track assets and liabilities apart from income and expense. Entries. In single entry, it will be one entry, while in double entry, two entries are made for each transaction. Accounting errors. Since single entry is one-sided entry, the chances of accounting errors are more. While double entry, there are two entries. For every debit, there is a corresponding entry. Credit. So the errors are much minimal here. What is the process? Single entry can be handwritten or it can be an Excel, while a double entry, generally it will be through a accounting software. Many organizations use Tally. Otherwise, you may also have some other accounting packages. Preparation of financial statements. It's much easier when your accounts are based on the double entry system, and it is little cumbersome when you have a single entry system. In fact, double entry provides more insights in analyzing the transactions and preparation of financial statements compared to single entry. Next slide. Let us now come to methods of accounting. This is also commonly which many organizations get confused. Cash basis of accounting versus accrual basis of accounting. So in cash basis of accounting, what happens? Expenses or transactions are recorded whenever there is an inflow or outflow of cash. Whereas accrual basis of accounting, transactions are recorded for a particular period. FCRA requires organizations to adopt cash basis of accounting. However, Section 8 company, if an organization is registered under Section 8, they have to do accrual basis of accounting for their company reporting. However, and cash basis for the FCRA reporting. Let me take an example. Please go through the example. Salary is due on 31st March 24. It is paid on 5th April. In cash basis of accounting, the entry is passed on 5th April when the expense is incurred. However, in accrual basis of accounting, expenditure booked on 31st March when the salary is payable for that particular period. So there will be one more account created, salaries payable account, and which is also called as provisions. And then later expenses are booked. So expenditure in accrual basis of accounting is based on the period for which it is, or income is for the period to which it corresponds. While in the cash basis, income and expenses are recorded when it is actually paid or actually received. Yeah, it's matching this way of generally accepted accounting principles. Now, there are three things in generally accepted accounting principles are commonly understood as GAAP. GAAP. So the principles are categorized into three categories: assumptions, principles, constraints. First assumption is separate entity. So when we say XYZ society is formed and the trustees are Mr. X, Mr. Y, and Mr. Z, there is a difference between, even though Mr. X is a trustee, his income or his expenses will not be treated as income or expenditure of XYZ society, because XYZ society is a separate entity in itself. So the first accounting principle is you are not mixing your own funds with organization funds. Next, monetary unit assumption. So the next assumption in the gap is all your recording of transactions are in terms of monetary unit, which is generally in terms of rupees. So if you don't have a monetary value attached to a transaction, no matter what you would have done, that will not get reflected in the financial reporting. So many organizations, what they say, we did it from our own funds. Me as a trustee, I have contributed to the work in my own capacity. Then that doesn't reflect in the finance report, no matter how much you have contributed. So first, the amount should come to the organization, and from there the expenses are booked, which means there is a monetary term attached in the accounting principle. The next principle is specific time period assumption. As we said, balance sheet is as on a particular date, while income and expenditure is for a particular period. So any financial reports you see, it will be for a particular period. Now, when you report to foundation, if the foundation grant is from 1st September 2022, then the first year reporting, when we ask, you will be giving the report for the period 1st September 2022 to 31st August 2023, because foundation goes with the annual reporting cycle. So any reports will have a definite period. So there is a specific period assumption. Going concern assumption. So what does this going concern assumption means? It means that organization continues for the future period. That is the reason when we say we have creditors or we have assets, which means we have assets in the organization which will be used for fairly good amount of time, maybe 3 years, 4 years, 5 years. When we say we have creditors, which means that we as an organization are not saying that we will not pay you. We are saying we are accounting that we have to pay, and that is being reflecting in the balance sheet, which means these are the payables for the organization. So it is a going concern. It's not like just because a reporting period is for a particular time, everything is stopped and later nothing continues. There is a continuing factor, and that is why balance sheets are prepared. Next, let us come to accounting principles. The first principle is historical cost principle. So when we say asset, we do not take the fair market value of the asset. We will not take the market value, even though the land would have costed us 50 lakh. The fair market value today is 50 lakh, but 10 years back it was only 5 lakh. Our balance sheet shows asset as 5 lakh because land is a non-depreciable asset. So the whole value will be shown as 5 lakh and not 50 lakh, which means historical cost convention. The second one is full disclosure principle. So if at all you look at your balance sheet, income or expenditure, the audited financial, there will be some notes also. Some of the organizations prepare notes. Some of the organizations prepare schedules. Say, for example, income. Income from Azim Premji, grant from Azim Premji Foundation, 10 lakh. Grant from another donor, 5 lakh. So total grants you may show in income as 15 lakh. And the schedule of grants will have from APF, 10 lakh. From another donor, CSR donor, another 5 lakh. So there will be schedules, there will be notes, and there will be also significant accounting principles. Generally, this will be part of your financial statements. Next is matching. The next two principles, that is matching principle and revenue recognition principles, are more concerned with the accrual basis of accounting. So in accrual basis of accounting, what we try to do, we try to match the income and expenditure for a particular period. So despite the fact that the expenditure is incurred or not incurred, expenditure is booked, or whether income is received, earned or not earned, income is recognized for a particular period. So this is more to do with accrual basis of accounting. However, many NGOs generally follow cash basis of accounting. Now let us come to the third set of gap, which is constraints. The first constraint is materiality principle. So what do you mean by materiality principle? I'll give you an example. We have transactions, okay? Say, for example, you as a approval person who is approving the payments, you have received expense statement for 50,000. In this 50,000, by chance, the person who has submitted expense statement has not given account for around 50 rupees or 100 rupees, which might be auto rickshaw charges. Or they might have taken some tender coconut or something for which bills are not available. Now, for 50,000, 50 or 100 is not a significant amount, means it is not material amount. So when we say it's not material amount, it means you as an approving authority can ask for a declaration from that person and you can approve the expenses. However, in this case, the person has spent for the flight ticket 15,000. He is neither giving you the boarding pass, nor he is giving you the payment details, nor he is giving you the ticket. Then it is substantial, it is material. Then you will not, it's not right on your part to accept this expense without a document. So what does materiality principle suggest? It means that we have to take a call in recording or classifying or even in approving transactions. What is material? What is non-material? What is significant? So the parameter of significance depends on what is the total value. So for the total value, what is the amount for which you are not able to get details? If it is significant, then you have to get details. If it is not significant, you can go to alternative way of approving those expenditure. Conservative principle. So the principle of conservative is like this. If at all you are foreseeing some expenses will happen, please do the disclosures in your accounting, in your financial reporting. I'll give you a very vague example. It may not be. So if at all you are foreseeing that you are working in a particular locality and you are foreseeing that in the near future, your work in this locality may not be possible because of external environment, maybe regulatory mechanism, or maybe the programs there have lost their significance, then it is significant and you have to disclose that in your financial reporting. When you are reporting, I mean, in the sense, when you are reporting to us, when you are giving the grant utilization report, there is also a narrative report which is associated with us. So any later part of things which you foresee, whether it is good or bad, it has to be definitely reported. Definitely, if it is something causing a significant disparity. You might have thought that the travel expenses are at 100 rupees, 80 rupees per kilometer. But you are sure that with the latest travel fuel prices, it is 100 or 110. Then there is a significant increase of 20 to 25 rupees, which you may have to also disclose or inform grant donors when you are looking at the next budget, or when you are also reporting the current utilization. as we know very well, budget and utilization are different. So when we say utilization, amount that is utilized is actual, which may or may not be equal to budget. Many times it is not equal to budget. So in the nutshell, the conservative principle is whatever are the foreseeing expenditure which will have an impact, you have to disclose that. Okay, objectivity principle. This principle says, so when we say audited financial statements, audit report, so what? We as an organization, we have prepared the financial statement. Somebody external is vetting that. He is saying it is true and fair. He is an independent person. So auditor is an independent person who is confirming on the fairness and the truth of financial statements. So this is what is called objectivity principle. And that is the reason why we say audited statements, especially all the statutory requirements has audited statements as one of the requirements. The last but not least is a consistency principle. So the consistency principle is whatever you are classifying. If you are classifying some item as expenditure this year, continue classifying the same item as expenditure next year under the same head. So do not make one time, do not say it is a workshop expenditure. Another time, even though it is workshop expenditure, just because you have a budget line in another program activity, do not group it there. So when it is a workshop, classify under workshop expenditure. When it is capacity building, bring it under capacity building. When it is direct program training, bring it under training. So whatever are your expenses, have consistency over a period of time. This facilitates a better comparison year on year or period over period. Next time. Okay, next one, I will not tell too much. It is the accounting framework and accounting standard. This is more a technical term, but it is very important why we require this. So accounting framework deals on three lines, three parts, which is what are the elements of financial statements? What is the time when it is to be recorded? And what are the disclosure principles? So when we say what are the elements, what is an income, what is an asset, when do you group a particular transaction as expenditure? So that will, accounting framework will give you that guidance. Next is timing. When should you recognize? In cash basis, you recognize when it is paid or received. In accrual basis, you will recognize for a particular period. Disclosure principle. So you are disclosing. When it is an asset, you will categorize in the balance sheet. You will not bring under income and expenditure account. Similarly, if it is a workshop related expenditure, you will not take the balance sheet, but you will bring under the income and expenditure. Institute of Chartered Accountants of India has given guidances in terms of accounting standards. So these are the various accounting standards which an organization, especially generally it will be the auditors who will be taking care of classifying, recognizing, and also timing of disclosures based on these accounting standards. Next slide. Now let us come to the crux of today's discussion. So as I said, Rule 17A. So there are various statutory requirements. The latest one, which was the circular which came in August 2022 by the Income Tax Department, notified the circular. And this is the Rule 17AA. So until 2022, there was a lot of ambiguity, confusion for the organizations in what is books of accounts, how to maintain, how to classify transactions, what is that we have to maintain records, what is that we have to really say if there is a particular transactions. And this would be a lot of, organizations would face a lot of difficulties, especially when they were presenting their case in front of the assessing officer when the assessments would happen. So Rule 17AA was notified in August 2022. Subsequently, the Form 10B audit report for the year 2022-23 and onwards has almost captured the whole Rule 17AA in Form 10B audit report. I think we can share those links to the public folder. Ravi, where we have Form 10B and the other circulars. Okay. We will share those circulars on the chat box, the links.
Even was PPT, Rajni, a few people asking for the PPT.
Yeah.
We will put the PPT and in that public folder and share the link to the public folder now in the chat box. That will be easier. Yeah.
So in a couple of minutes, we will put the PPT, the circular, that is the Rule 17AA circular, and also Form 10B, 10BB audit report on the public folder, and we'll share the link. You may have a look at it, but please, as of now, try to listen. Later, you may also go through the same. So why I am emphasizing this part is, first rule was, okay, before Rule 17AA, what happened when the renewal came in? As all of you know, 12A and ATG renewals had to happen for every 5 years. Earlier, it was perpetual. So when the renewal came in, with the renewal certificate, which is Form 10AC, which we received, there was this points 9 and 10, which had a lot of things to be done or not to be done by the NGOs, which meant that your 12A exemption may be cancelled if you
Ma'am, you got muted.
Sorry, we're not able to hear.
We can't hear you.
Yeah.
Am I audible?
Yes, now you are audible.
Thank you. So what happened when we got our renewal certificates? You might go and look at your renewal certificates. Points 9 and 10 clearly has the various conditions. So which meant that if you do something or if you don't do something, your 12A exemption may be cancelled. Since those certificate requirements were not binding, Rule 17AA was notified by central government, by the Income Tax Department in August 2022. So once Rule 17AA came in, which means organizations are bound to comply with that rule. Now, the next level of security check, I can say, what happened was, it's not enough that you as an organization comply. It's required that auditor should also certify this. So the Form 10B and 10BB, which got changed or revised in February 2023, last year. And this was the audit report which was applicable for 22-23 financial. So auditor had to certify. Now the question comes, what happens? When an auditor certifies, it means, if you look at the auditor statement, it says very clearly, based on books of accounts and information provided by the organization, I certify. So the primary responsibility is on the organization to maintain books of accounts and information. So based on what you say, auditor is certifying. Based on what you maintain, auditor is certifying. So we cannot say, I mean, many a times we feel that, okay, auditors have done, we don't know what auditors did. No, it is the responsibility of organization because you are also signing on those financial statements. You are also, when you are filing the ITR, you are uploading and you are mentioning there as an organization head that all the information provided is true and correct to the best of my knowledge, whatever. So it is a responsibility, and we request organizations, especially people who are authorized signatories, who are under governance and the management, to also understand the criticality of this information which you are certifying, and also know what you are actually saying. It is true in the letter and spirit. Now let's just go through this example. XYZ Society is registered in Udaipur. Since their activities are more in Jaipur, they have an admin office in Jaipur and they have an accountant in Jaipur. Now, accountant, what he is doing? He is recording the transactions in an Excel worksheet. Okay. And he is recording based on bills available, and whenever the trustee, the secretary is approving some expenses, secretary is giving those expenses details also to the accountant, and accountant is recording everything in an Excel. At the end of the year, accountant submits this Excel, submits the bank statement and whatever bills vouchers he has to the auditor, and the auditor prepares the financial statement. This is the example. Now let us try to see each point of Rule 17AA. Next. Is the organization required to maintain books of accounts? Yes. Rule 17AA is applicable for all charitable organizations who have exemption under Section 12A or who are registered under Section 1023C. So it is applicable irrespective of whether you are a trust, you are a society, you are a Section 8 company, you are an early stage organization, you are a CSO. No matter what the organization is. Once you have your 12A exemption, this rule is applicable. Next. Okay, now I have put there the form 10B or 10BB extract. So in simple things, I'll say organization's audit report may be under form 10B or 10BB. So an auditor is required to give audit report in form 10B if an organization's overall receipts during the year is more than 5 crore, or if an organization has FCRA registration or FCRA income. And the third one, if the organization is carrying on operations outside India. Any of the things, form 10B. If none of the things is, if your organization is not more than 5 CR or you don't have FCRA, then form 10BB will be applicable. So you might look at your audit report. It may be form 10B or form 10BB. For example, an organization received its FCRA registration, means first time it was registered on 1st of February 2024. For 22-23, auditor will file form 10B, but for 23-24, if an organization is registered and it has some income, maybe even 1,000 rupees under FC, then the auditor is required to file form 10BB. So anyway, coming to the specific disclosure, what does the form 10B, 10BB audit report say? The audit report has two sections. One is the certificate. Auditor is certifying. And below is the annexure. So annexure to the audit report, which has all the statements, various details. So in the certificate auditor says that the books of the accounts are maintained as per point 14 of the annexure. So let us look at point 14 later. But as of now, what it means, books of accounts is maintained by the organization. This is what the auditor is certifying. If in the above example, is the books of accounts maintained? No, because the accountant is recording only in Excel. Books of accounts are not maintained. So organization has not complied Rule 17A. Auditor has all the rights to qualify his report. Next. Location. Just give me a minute.
Location slide. Yeah, sorry.
Okay. Now let us look at location. Where are the books of accounts to be maintained? As I said, Rule 17A, you can look it as one of the sacred scripture for you. No matter whether you have any sacred scripture, please take this printout and keep it on your tables, on your places, wherever, and keep looking at it because it almost gives the complete guidelines of what an organization should do and what not to do. So where is the location? Rule 17AA requires the books of accounts to be maintained at registered office. In this case, books of accounts have to be, in the above example, books of accounts have to be maintained at Udaipur, where it is registered. Now, what happens? Many organizations, they would have given their registered office as their home now, house address, but their office may be different. So, you are not maintaining books of accounts at registered office, which means you are not complying with the rule. So, why? Why should we comply? The simple answer is when an income tax officer wants to visit, they will go by your registered office address, which is disclosed. When they go there and they see it's just a home, there is nothing, they may say that organization is not functional, it is a defunct organization and may cancel your 12. So registered office is very, very important. Now, if books of accounts are not maintained at registered office, if it is in any other location, what is it you should do? The rule says, pass a board resolution. Within 7 days, intimate the change of address to the assessing officer where your jurisdiction is. And that assessing officer should confirm in writing that the books of accounts are maintained in such other office. You are not changing the registered office here, but you are giving the details of other office to the assessing officer. Please understand, change of registered office is different from informing of such other office. So whatever we term it as administration office or branch office, whatever you want to say. So it is the such other office. So what happens now? Form 10B. Point 5 and point 6 of Form 10B. It says what is the office address, what is the other office address. Now, when you go to point 14 of Form 10B, it says, it asks what are the books of accounts maintained, whether it is maintained at registered office. If not, whether the assessing officer is intimated and whether the assessing officer has approved. If he has approved, you also have to give the details of such approval. So these are the disclosures. So what it means in principle, you are making these disclosures and by this, the transparency is enhanced. That is to say that income tax office knows, fine, in registered office, nothing is there. It is in such other office, so organization is still functioning. It's not an organization which is closed and I should not cancel their 12. Now coming to 10BB, I think it is point 11, which says whether the books of accounts are maintained or not maintained. Next slide. Form and manner of maintaining books of accounts. So, Rule 17AA again has said you can maintain in manual form, or you can maintain in electronic form, or you can maintain in some EDP, or any other form. So, when it says or, you can maintain in any of the forms. However, it is advisable to maintain in one particular form. Say, for example, when we visit some organizations, they say, we maintain these ledgers in manual form. We maintain these ledgers in Tally. So it will become very difficult for the auditor or for us to know what is in Tally, what is in manual form, and also preparation of financial statements becomes an uphill task. So you can maintain in any form, but ideally please maintain in one form and let that form be consistent over a period of time. So ideally, since the accounting packages are much beneficial in terms of classifying of information, recording, interpreting, it's always better that you maintain accounts in some accounting packages. Generally, it is Tally. Now, again, coming to Form 10BB and 10B, as I said, Section 14 also says, point 14 of Form 10B says very clearly that whether the books, like if you say cash book, it asks whether it is maintained electronically or manually. If you say electronically, then whether it's maintained at registered office or such other office. So the whole disclosures are to be given in Form 10B. Next slide. Records management and period of retention. Now, what are the records? So, what is records? Records is the set of all those information which the organization is bound to have in. Why it should have this information? To justify the transactions. Now, let me give an example. If at all we say foundation grant is received, what is the record you should have? The record you should have is the grant agreement with foundation. If you don't have the record, even though it's received in a bank form, it doesn't make sense because you are not maintaining complete records. So records are all that information which substantiates what is the source of income, how the income is received, what is the source of, how the expenditure is incurred, and what are the documents to justify those expenditures. If an asset is purchased, whether you have the assets, title deed. Say, for example, land is purchased. The land should be in the name of organization. This is something which we have seen organizations having the title deeds in name of trustees or the governing body members, which is again contradicting or a violation of Section 12. That we will deal little later, in the subsequent webinars. But as of now, the record should be clear and unambiguous. There should not be any ambiguity. So books of accounts should be there. So with books of accounts, what you should have? All those documents to justify. So it may be invoices, it may be purchase orders, it may be bills, it may be distribution to the beneficiaries, it may be face vouchers. All those come under books of accounts. Then you have files. So what does these files have? They will have the project proposals, grant agreements, MOU, consultancy agreements. All these will be in the files. And the third is title deeds, which means all your registration deeds. Now, how are the, some tips we have given here. So, ideally, please hold all your registration documents, the grant agreements, and other important documents in safe custody. Preferably, as much as possible, convert everything into soft copies and store in a specified folder, so that whenever somebody comes to review, you can always show the soft copy, and only when it is required, you may take out the hard copies, means the original documents. The regular running files can be in files form, means loose sheets, which is filed. Sometimes we have also seen some organizations when we go, we see a bunch of vouchers not filed. It's really not a good practice, because even if some bills are missed, which means we will not be able to understand the basis of such expenditures, and the chances of such expenditures getting disallowed is more. So have a proper filing system in place. And in general, it is advisable once the audit is over, the financial audit, the statutory audit is over, you may bind all these voucher bills in a chronological order and bind and keep it, so that those documents are not misplaced later. For example, if at all 22-23 audit is over, and maybe from foundation we come in September, if you remove the documents from the 22-23 file, and if you misplace it later when there is an assessment, and if the assessing officer asks for those expenses, then if you're not able to substantiate with records, the chances of that expenses getting disallowed is more. So it's ideal that once an organization closes its books of accounts for a particular period and the audit is completed, bind all those files, put it in a bounded copy, and retain it so that documents doesn't get misplaced. Now, what is the period of retention? The rule 17A says it should be retained for 10 assessment years, which means 11 financial years. I think I have to explain about the assessment year and financial year, even though I am diverting a little bit. You please see your 12-way registration. In 12-way registration, point 8 or point 6, one of the points says 12-way is valid up to assessment year 26-27. If it says assessment year 26-27, which means 12-way is valid up to the financial year ending 31st March 2026. So some of the organizations, what has happened, which we have seen, the 12-way. Yeah. So the 12-way, if the validity will be up to assessment year 24-25, which means the validity is expired as on 31st March 2024. So please understand the difference between assessment and financial year. Assessment year is the year after financial year. So if at all, when we say 10 assessment years, it means 1 year before, that is 11 financial years. And what is it? If an assessment is open, say for example, if at all we are looking at 22-23 financial year. So from 2011-12 to 22-23, you should maintain the books. Now, for example, let us assume the assessment for 2013-14 is in progress. Then for the past 10 years, you should maintain. Because assessing officer has the right to ask you for the details from the assessment year 10 years before. So in principle, what we say, please maintain all these books of accounts. If possible, maintain in such a way that year on year you are able to segregate the information, the details, filing system is proper. And if an assessment is not closed on the income tax website, then you please maintain for 10 assessment years from that assessment year for which it is not closed. If at all, for example, if your assessment is closed up to 2014-15, which means from 2005-6 onwards, you should maintain, because if, for example, assessment happens for 16-17, they may ask details for 10 years from 16-17 before. So, in a nutshell, records is to be maintained in an accessible form. Original documents is to be under safe custody. As much as possible, try to maintain in a soft copy so that you need not look at or remove the original documents. And once an audit is over, please bind the documents and keep it safe. Next. Okay. Implication if organization fails to maintain books of accounts. So what happens? Now, the first and foremost, one of the requirement of an organization, if they have 12-way exemption, is they have to maintain books of accounts. If an organization is not maintaining books of accounts, your 12-way exemption can get cancelled. Another requirement or essential condition of 12AB is if an organization provides false or improper information and the income tax office comes to know that the information provided is false, even then your 12A can get cancelled. So in this case, if an auditor has certified that the books are in registered office and it is not in registered office, then it means that improper information, false information is provided. So now earlier it was the Commissioner of Income Tax who had the right to cancel 12A exemption. Now even the assessing officer can recommend to the Commissioner for cancelling 12A exemption. So it's not required, it's not necessary that an assessment should happen. Even if an income tax officer comes, visits the organization, and if he sees that the documents are not there, if he reports that to the Commissioner of Income Tax has the right to cancel. However, if so there are two things. If the 12A is cancelled, entire income becomes taxable. You lose your 12A exemption. You have to apply fresh registration. If at all you go, you plead, you say it was inadvertently done, and if the commissioner doesn't cancel, then your income will be taxable under the provisions of Section 1310, which means whatever expenditure you have incurred for the objects of the trust, if your objects is providing relief to the poor, any expenses for providing relief to the poor is not taxed. Other expenses are not considered. Means that is a disallowed expenditure and it will be taxable. Next. Okay. Now let us come to basic books of accounts. Actually, I will conclude with this because I wanted to also take you through the transactions with specified person, but it will be beyond 12 o'clock. So we will try to conclude with the basic books of accounts. This is also quite important. And we can take the next webinar. We may try to cover transactions with specified person. Now let us come to basic books of accounts. Now what are the basic books of accounts? Cash book, ledger, journal. So I'm sure all of you are aware. Cash book is also called as day book. So day book is what? It is recording of transactions. People who know tally, or I'm not telling more to the account people. For the others, you will be aware that generally what an accountant will do once the transactions occur, then they will record in the day book. So day book will have two columns, one for cash, one for bank. Means whatever are the cash expenses, it will be recorded. Whatever are the bank related expenses, it will be recorded. Now, by default, if you are using a tally package, once you record in the day book, corresponding entry will be taken care. Means you need not get into the double entry principle. So many organizations get confused. What is double entry? What is single entry? So for tally users, please understand, once you make an entry, if you say asset purchased 45,000 in the day book, immediately your fixed asset will reflect that 45,000, provided you have created those ledgers. That is why chart of accounts are important. So once your chart of accounts are created, automatically the package will understand where the other, the other side of transaction is to be recorded, and accordingly it will be done. So day book. Then you have ledgers. As I said, ledgers are your various ledgers. For example, you may have a ledger for workshop and trainings. You may have a ledger for center expenses. You may have a ledger for administration, office rent and maintenance. You may have a ledger for postage and telegraphs. You may have a ledger for printing and stationery. So these are the various ledgers. Now, what are journals? Journals are those entries which you may have to make. Number one, if there is a correction, maybe by accident, instead of writing postage and stationery 1,000 rupees, if you have written printing and stationery 1,000 rupees, what would have happened? The expenditure in printing and stationery would have increased by 1,000 instead of postage. Sorry, expenditure in postage would have increased instead of printing and stationery. Then you will have to pass a rectification entry. So what you will pass a rectification entry? You will pass a rectification entry debiting printing and stationery and crediting postage, in which case postage expenses reduces by 1,000 and printing and stationery, which is the actual expenses, is increased by 1,000. So these are the journal entries. Another thing where we pass journal entries are generally when we have to account for some expenditure which is not actual expenditure. For example, depreciation. When we have to book for depreciation, that is the time when we form journal entries. Or during audit, when there are some corrections which has to happen, at that time journal entries are passed. Journal entries are passed for closing the books for a particular period. So journal entries is little a technical term, but please understand the records that has to be maintained is cash book and ledger. Now, when you are making some, when you are receiving, then you should have original receipt book. You should have, if at all you are paying, you are running an organization where some fees is collected, then you should have a fee receipt book. And if you are having some sale of products like handicraft or something, then you should have a sale receipt. So if you are issuing, if you are receiving anything, then you should have documents. Please understand it says originals. So you cannot maintain Xerox copies. Now I'll come to the thing of maintaining scanned copies and other things little later. Similarly, for the payments, you should have original bills. It is recommended to have face vouchers because many a time what happens, you cannot write which ledger is to be debited, which ledger is to be credited, who is the donor, other details you cannot put on the bills. And approval mechanism also may not be so clearly documented if it is the bills. So it is always better you have a face voucher and purchase orders, all other supporting documents to substantiate the transactions. Now, a question arises whether we can book expenses based on soft copies. Especially during the COVID times, what happened? We were not able to get the bills. So we would get scanned copies from the vendors. So is that acceptable? Yes, it is acceptable because even Rule 17 EAS says you can maintain records in books of accounts in manual, digital, electronic, whatever. It is acceptable. But please follow the principle of consistency. And when you are more going into the soft copy version of the documents, it should be an authentic. We can accept or approval should happen for those soft copies which has come by mail, not by WhatsApp. Because WhatsApp, today somebody has a mobile number, tomorrow that person does not have a mobile number. Emails are okay. And once a soft copy comes, and if at all you are maintaining all the records in hard copy, take a print of those soft copy and attach with the voucher. So these are some of the ways in which you can try to maintain consistency. So the ultimate principle of maintaining documents in one form is you are not getting confused whether it is in manual or in soft copy or by mail or whether it is uploaded on the Tally, nor you will confuse when donors or when somebody, other stakeholders ask for information. So consistency is very important. And when you are maintaining documents in soft copies, especially the supporting documents, there should be adequate internal control system so that there is no leakage of funds. Now, the other requirement of the Section 17A is if at all there is any incidental business or if there is a business, say for example, if an organization is having a training hall and it is charging some hall charges and providing this training hall for others, it is an incidental business for the organization, then it should maintain separate books of accounts. Now, even for FCRA requirement is there for maintaining separate books of accounts, that is separate income, separate expenditure, separate cash books, separate ledgers for foreign contribution received and paid. Now coming to disclosures, Section 4.14 of Form 10B requires whether all these books are maintained. However, Form 10BB generally says whether the books of accounts are maintained as per Rule 17A. Now let us see few good practices in bookkeeping. So one of good practices in okay. First and foremost, if at all you are using Tally or other software packages, please have a restriction on the edit access. Means there should not be scope for the person who is recording transactions, that is the accountant or accounts officer, whosoever, to do backdated entries. Or if a backdated entry has to be made or a correction entry has to be made, it should be informed, means there should be a approval process. So once you have restriction on the edit access, the problem of backdated entries, or sometimes we have seen in one of the organizations when we went, they have cost centers. So every time the report they were giving us was different, because now say for example you have workshop. In workshop you have cost centers for all donors, 5 donors. So when they are reporting to APF, sometimes they are writing to foundation this particular expense. Next time when they are reporting, that expense is not for foundation, it's for some other cost center. Overall, your workshop expenditure doesn't get affected here. But between the donors, some donor you are reporting sometimes different amount. So all these edit access to certain extent will mitigate the risks of wrong reporting. Okay, vouchers, as I had told, it's recommended that you have face vouchers, and once expenses are booked in Tally, once expenditure are incurred, it is always good to have to deface the voucher, means have a rubber stamp. Say for example, if you are paying from foundation grant, we say you have a rubber stamp saying that paid from APF or paid grant number so and so, and put on all vouchers and supporting documents, so that that expense is not inadvertently booked to any other donor, or there is no chance of booking that expenses again. Okay, records management is important. So as we said, retention requirement is there. Maintain records properly. So again, repeating as much as possible. Original deeds, registration documents, certificates have to be in the safe custody. Yeah, here one more thing which I want to emphasize is what we have seen many a time. Many organizations do not have their income tax login and password, do not have their traces login and password. So you are not sure, you don't have quarterly returns, TDS quarterly returns available with you. You don't have FC4 annual returns available with you, nor you have the access where you can download. So it is advisable, and we recommend you please have the access for all these websites where the information is available. And as much as possible, download this information and put it in a folder. Say, for example, quarterly returns for each year, download and put it in a folder, so that, at any point of time, even if the website is not working, still you have the information available. Means still you can demonstrate that you are complying to the laws of land. Okay, establish internal checks if possible. Follow the principle of 4 eyes, which means one pair of eyes checked, means one person checks and the other person approves. One person incurs expenses and other person books expenses. So there is a proper segregation of duties. There is an approval process, and also establish some internal controls, which means that management as such has details to understand where at each level there are controls in place, so that even simplest of simplest, there is no misuse of funds, and even if there is any leakage of funds or frauds or misappropriation, that comes to the light of management immediately. We have only 4 minutes left. It takes time. Yeah. Okay, so what I will do, I will revise my next webinar. I was thinking of doing the income, but we will try to look at the internal controls and transactions with specified persons in the next webinar. Because I know that I think I elaborated. I thought it would be important for me to give more information. Yeah, as we close the session, we really thank you for joining the session and being part. And I'm sure that many of you would have also posed certain questions. We will try to answer them. We would also appreciate whoever have not written their name, designation, and organization name. Please do it. And your feedback is very, very important for us. If you have any suggestions to make these webinars much better, please write in the chat box. And yeah, as I promised, if at all there is a requirement to do this session in Hindi, we will do it in the subsequent webinars. Once again, from Azim Premji Foundation and all of us here, we thank you for this for attending this webinar. Thank you so much.
Thank you, ma'am.
Thank you, ma'am.
Thank you.
Thank you, Rajni. Thank you, Rajni.
Thank you, ma'am.
Thank you, madam.
Thank you, ma'am.
Thank you.
Thank you, madam.
Thank you, madam. Thank you, madam.
Thank you, madam.
Thank you, ma'am. Thank you, ma'am. Permission. Permission, thank you for that. I think I'm going to do it. Introduction, yes, no. Yes, no. Hyderabad.
Thank you, madam.
Thank you, ma'am.
Ready?
पुढं चालू ठेवायला त्या बॉम्बला
Chipper पटको. आज चालू नाही तो.
आणि रात्री पेशंट ते आदळून
Really, it was a key learning.
ನಾನು ಈಗ ಖರ್ಚು
ಹಲೋ ಏನಾರು ಹೋಗ್ತೇನ
वेबिनार
बर ठीक आहे नाही ठीक आहे कारण आज पण वार आहे मंगळवार आहे नाही बर ठीक आहे नाही काम नाही सकाळी मीटिंग झाली
Thank you, ma'am.
Okay, thank you.